Hey guys, in this video I want to walk through 3 ways to manage a losing trade when you're trading credit spread. So it's quite simple. I'm going to walk you through it using the Trade Saver, but I'm explaining step by step exactly what you can do for each different scenario because there's 3 main ones when you're trading credit spreads. So if I come over here to the Trade Saver, I'm just going to plug in a trade that I have right here. So that's going to be this one, and I'm just going to show me this trade. Actually, it wants me to pick this one. Okay. Here we go. So basically you just plug in a trade and it shows you how to save it, but I want to walk you through why it tells you to save it in these 3 ways. So the 3 ways to manage your losing trades is this. Number 1 is the expiration day plan, number 2 is the early close plan, and number 3 is the roll your trade plan. So let's go over option number 1. So option number 1 has the ability to cut your max loss in half by 50%. So what is that? Anytime you enter a credit spread trade, by default, you know what your max profit is going to be, and you also know what your max loss is going to be. Anytime you enter a credit spread trade, you should expect to hit your max loss. That is what every credit spread trader should automatically think. Can I withstand the entire max loss? If I can't, then number 1, don't trade, or number 2, size down. It means you're trading too big. So you want to make sure you're able to withstand taking the entire max loss. So if you're okay with it taking the entire max loss, then we can move on to one of these 3 ways to mitigate those losses when a loss does occur. Now, the next thing I have to say before we continue with these different strategies is a trade is not losing if the open P&L says it's losing. A trade is losing, for instance, if it's a put credit spread, if the stock is below your strike price. So again, just because your open P&L shows something negative does not mean the credit spread trade is losing. A credit spread trade is losing when your stock is below your strike price, meaning that if the trade were to expire, then you would 100% lose. And so that's what we're looking at right here, looking at if the stock is starting to be at or below our strike price for a put credit spread and vice versa for a call credit spread, then we can look at ways to manage that risk. Okay, so the expiration day plan. So you're going to hold the trade until expiration day. So again, this plan is again highlighted because it's what's recommended for this trade, but essentially if you have less than 7 days left in that trade, meaning that the days until expiration for your current trade is less than 7 days, and it just crossed your strike price, it is best to hold that trade until expiration day. Why? Well, because it can, especially if the trade is going in your favor, trending like you're trading with the trend at the moment, then it's most likely going to come back in your favor. You can let theta decay do its work, and you can maybe make some money. If not, you can sell early and in the morning on expiration day, and typically take 50% of the max loss as your actual loss. So now you're saving 50% of that max loss. Again, you can read the explanation here for it as well. Option number 2 for mitigating risk with a credit spread strategy is using an early close plan. So this is if you are trading a option or a credit spread that has more than 7 days until expiration, and the trade has gone against your strike price, gone below your strike price, and you're no longer trading with the trend, which means that it's most likely going to continue down. So if those sets of criteria are met, then what you want to do is you just want to close the trade out. And so what you're going to do is you're going to open your broker, you're going to go to the order, and you're going to close that trade out. And you can typically close it out if it's a $1 spread for 50 cents. Again, if it's just now cross below your strike price, you can roughly close that trade for 50% of the width. So if it's a $1 spread, you can close it for roughly 50 cents. If it's a $2 wide spread, you can close it for roughly $1. So again, that's how you create your loss. Again, if you want to explain, all the details are here as well. Option number 3, and a bit more of a complicated approach, is to roll your trade. So rolling your trade has 2 different categories. This is best for, again, if you're getting close to expiration, roughly 7 days out, and your strike price is about to get hit or getting hit, or it's below your strike price. Now, again, you have 2 different options. If you're trading with the trend, which meaning that, let's say, long-term the market or this stock that you're trading is bullish, right? The trend is going up, higher highs and higher lows. Well, if you're trading a put credit spread, then you're going with the trend. So you should hold on to this trade. It's going in your favor, or it's trending in your favor, so it should eventually come back. So what you can do is you can roll out the put credit spread a little bit further in time, collect a very small credit to roll that out. You typically have to double the width when you do. And then again, you can actually recover the entire max loss and make a little bit of money when you do that. So again, now you're saving the entire max loss. Now, if you aren't trading with the trend, let's say the trend has reversed, let's say it's now starting to trend down, it's starting to be bearish, but you're going to put credit spread, then what you want to do is you want to do the same thing, roll out about 7 to 10 days, but instead of rolling to a put credit spread, you want to roll to a call credit spread. You're still going to collect a very small or $0 credit, but again, you will offset all the money from the max loss to be able to put this trade on, and now you're trading with the trend, so this trade should work out in your favor. So again, if you're trading credit spreads, number one, understand that you're going to take the max loss. If you're not comfortable with the max loss, size down. Number two, understand you're only losing on a credit spread trade if it has broken your strike price. Number three, pick your ideal way to mitigate your loss, either the expiration day plan, the early close plan, or the roll your trade plan. If you want the plan to be given to you step by step, then again, you can click down below and check out my Credit Spreads Trade Saver program, which is a tool. This tool is included with the Inner Circle program, so you can click down below and learn more about that. But anyways, these are the 3 best ways to mitigate your losses as a credit spreads trader. If you enjoyed or learned something from this video, smash the thumbs up button and smash the subscribe button, because I come up with videos every single week to help you profit from the market as a credit spreads trader. All right, see you in the next video.